Oracle's share price dropped after their earnings announcement. Roblox is the next meme stock according to The Economist, and maybe stay away from Bed Bath & Beyond stock for now. All this and more on this week's Invest Roundup. Hey folks, it's Terry and you're watching another episode of Invest Roundup. Last week's market movement was dramatic to say the least. The Dow jumped 200 points to its all-time high end of last week after President Joe Biden signed a $1.9 trillion stimulus package to get USA back on track now that the country is slowly recovering from the pandemic setbacks. The Bitcoin rally continued to accelerate and went right through the roof, hitting a record high of more than $60,400 early Saturday morning. Unfortunately though, it's not all songs and dance in the vaccination department. There's now trouble in vaccine paradise because a growing number of recipients across different countries are reported to have blood clots after receiving the AstraZeneca vaccine. Let's get into this week's news. Disclaimer: whatever stock or news we talk about is not a recommendation to buy or to sell. These are all just news we deem important, things we believe you need to know if you're invested in the stock market or if you intend to invest. First news item, let's talk about something that hits closer to home, like literally stuff in your own home. 4 words: Bed Bath & Beyond. Home furnishing giant, a little bit of a trouble company, but mostly one of the most commonly shorted stocks by short sellers. Now, we usually like sharing about good stock buys or undervalued stocks, but today we're switching it up to talk about a stock that, instead of thinking twice before investing in them, you'd want to think for the third, fourth or fifth time before sort of staying away from them for a bit. Revenue for the home goods retailer has declined by 14% in the last 4 quarters compared to the year before that, but strangely, the stock has gained more than 200% in the last 12 months. Red flag? You think about it. Since the beginning of January this year, around more than 2 months ago, Bed Bath & Beyond share price started to rally. I mean, it rallied. From $18.73 to one of its highest peaks in the last 5 years, $52.89 within just 20 days. All because there was a new management at the helm and everyone was betting on a seemingly promising turnaround. The management was selling off side businesses that weren't working, they were closing around 200 stores, initiating an aggressive stock buyback plan of more than $650 million and posting encouraging gains in its online business. Basically, the whole makeover jazz. Which honestly sounds like a great plan to some, except not everyone thought so. During the rally, fund houses which were bullish on this started downgrading their ratings and bailing. Everyone else, of course, followed suit. The share prices started to free fall, losing 52% within 6 days, and we thought that was the end of that. Until early this month, the CEO of Bed Bath & Beyond has introduced the first of several private label-owned brands which they say will transform the merchandising strategy of the company. And the rest of labels will be released the rest of this year and next year. As expected, stocks started to rally again, but for like 3 days and it dropped back down. So what does this tell us? Even though Forbes has said that it would be unwise to bet against Bed Bath & Beyond's turnaround, it is obvious that this stock is prone to short power bursts which will later deflate and cause the share price to drop back down quickly. Something that is definitely not for long-term investors, but if you're not the kind that's in stocks for the long haul, this just might be for you. The stock is also considered to be a high-risk investment, showing all sorts of potential red flags in the receivables management and inefficient use of their capital. That said, one question does remain. Will this stock eventually flourish, or will the share price go back down so low only geologists can find them? Second news item, make way for the next meme stock, Roblox. All hail the next meme stock. Or so it says on The Economist. Incorporated in 2004, Roblox Corporation is the latest video gaming business to go public, listing on the NYSE just last week. Thanks to the COVID-19 outbreak, the company have experienced accelerated growth and reported as many as 32.6 million daily active users in 2020. Now, make no mistake, Roblox is not a game developer even though they are in the online gaming business. They are actually a free online platform that features tens of millions of multiplayer games made by players themselves using the tools on Roblox. And the company generates revenue through the sale of its Robux currency, which users can spend on virtual experiences and items for their avatar. Last week, Roblox has followed the footsteps of fellow gaming companies Corsair Gaming and Unity to capitalize on the trend of stock market listing, with shares opening at $69.50. Unlike these companies, however, Roblox has gone public via direct public listing called DPO instead of IPO. That means they cut off the investment banks, broker-dealers and underwriters which would typically be involved in an IPO, hence substantially lowering the cost of the listing. Now, if you're thinking, just how promising is Roblox? Let me tell you, it is Cathie Wood level of promising. For those of you who don't know, Cathie Wood is the owner of ARK Investment Management, which is the largest actively managed exchange-traded fund in 2020. She was also named the best stock pick of 2020 by Bloomberg, and she picked Roblox to invest 500,000 shares to be exact. So, you do the math. According to The Economist, Roblox checks most of the boxes to become a meme stock. For example, they already have a pseudo ticker on Wall Street Bets, which is $Sears after Sears Roebuck. Unlike GameStop, however, Roblox is popular among venture capitalists and Wall Street bankers. Looking at their financial results, things are not looking too rosy just yet. Even though they are a fairly healthy company, it doesn't look like the company is very profitable at the moment. Might want to give it some time in the stock market. But you know what doesn't need time in the stock market? Hitting that subscribe button right now. We bring you the latest market news every Wednesday, so smash that notification bell to make sure you don't miss out. Now, back to the news. And finally, things are not looking good for Oracle. I don't know if you remember our episode a few months back in December, but the gist of it was this. For years now, Oracle has been sort of snitching on Google, dealing with authorities in private and convincing them to take action against the tech giant, presumably to strengthen their own position. Unfortunately though, the law of nature is this. If you bring down others, the universal force will bring you down as well. And that's what happened with Oracle. Well, in a way. Early last week, the company was all smiles announcing their latest financial results as well as their plans to transform their business for the cloud computing era. And it honestly sounded quite fantastic. Revenue for the previous quarter was up 3% from last year's. There's a $20 billion expansion of the stock repurchase program, and they've lifted their quarterly dividend from 24 cents to 32 cents. However, despite all the growth, Oracle unfortunately did miss some analyst projections, and according to Barron's, this left some investors disappointed with the pace of the company's return to revenue growth. So, they started dumping their shares and have caused share price to drop by 8% in the last week, one of their biggest falls in the last year. Not only that, in the headline, CNBC have also said Oracle's planned wave of capital spending won't put it on par with cloud leaders like Amazon. Bear in mind now, Oracle shifted to cloud software business to compete with the likes of Amazon, Google and Microsoft. And now, with this headline pointing out that Oracle will not be on par with these companies, it's like taking a cookie from someone who's craving a cookie and then slapping them across the face with it. Anyway, for the record, I'm not vouching for anyone here, just here to deliver a lesson. Snitching on others is bad. So, those are the 3 important investment news we had to share with you this week. Once again, we encourage you to get more information if you'd like to act on any of the companies we shared about earlier. Comment below and tell us what you'd like to see on the next Invest Roundup, and share this video with your friends, especially those who are invested in the stock market. We'll see you next week.